All right. The next problem that we're going to work through is exactly the same problem we just did with one difference. Is that instead of being classified as a trading security, we're now going to classify it as available for sale. Everything else is exactly the same thing. So, example 2, no significant influence. Any securities classified as available for sale. Assume the same facts as example 2, except that the securities are classified as available for sale and ignore all taxes. There's going to be exactly no changes to anything that we did in parts 1, 2, 3, and 4, except that the unrealized holding gains and losses are not income statement accounts and not included in the income statement. Instead, they're reported as components of accumulated other comprehensive income in stockholders' equity. In other words, this journal entry, exactly the same. This journal entry, exactly the same. These journal entries, the same, except instead of saying income statement, they would say balance sheet or accumulated other comprehensive income, something to that effect. For all of these, exactly the same. These guys, exactly the same. These guys, exactly the same, except the realized ones go to the same place for available for sale, but the unrealized ones, these guys down here that say income statement, now would say balance sheet. But everything else is exactly the same as what we just did. So now what we're going to do is we're going to look at part 5. How would these transactions appear on the balance sheet, on the income statement, on the statement of cash flows? And you're going to see that there are some differences on where they show up because of that one difference of where the unrealized gains and losses go. For trading, they went to the income statement. Here, they're going to go to the balance sheet and skip the income statement. So a lot of these numbers are going to be the same, but there are going to be some changes. So for our income statement, our investment income from dividends stays the same. We still had $10,000 in 20A and nothing in our other 2 years. So nothing changed between trading and available for sale between them for the dividends. No difference. The gains and losses on the sale, again, are exactly the same. There's nothing in the first 2 years, and we have a loss of $15,000 in our 3rd year. But the first difference we see here, and you can compare, this is what we had previously. I'm sorry. This is what we had previously. Now these guys, the unrealized gains and losses, don't show up on the income statement. Because that's the difference, right? And so the only effect we're going to have on our income statement is the realized and the dividends for these available for sale securities. No other effect on the income statement. On the balance sheet, they're still going to be at their market value. These are going to be exactly the same as they were last time. They're going to be $1 million, $990,000, and $750,000. They still got marked to their fair value, just the same as last time. Retained earnings is going to be different, though. Why? Why is retained earnings going to be different? That income changed, right? Only the stuff that's now in that income is going to affect retained earnings. So what's going to be retained earnings at the end of the first year? $10,000. What's going to be the end of the second year? $10,000. $10,000 again. What about the end of the 3rd year? -5. Very good. Which was very different than last time, right? So last time it was 260, 250, and 345. It's very different than 10, 10, and -5. But now those unrealized gains and losses go here in accumulated other comprehensive income, a shareholder's equity account. So instead of being up here, now those same numbers are down here, and they were 250, 240, and 350. So essentially what happens is those unrealized gains and losses skip the income statement, so they didn't go through the income statement, and they went straight here to the shareholders' equity section. And one thing that you should probably notice is that the shareholders' equity section, what's the total effect to shareholders' equity? 260. What about in the second year? 250. What about in the 3rd year? 345. Those are exactly the same numbers as what the effect was last time on the shareholders' equity. But it was just in one category last time, retained earnings. But it's the same effect to shareholders' equity, just in two different categories this time. Yes, sir?
So please, when did you get it to 240?
The 250, 240, and 350, these were the numbers that were the... I just picked the wrong numbers, did I? No, you got me.
No, they're right, it's just,
Oh.
it's on the balance sheet, right?
Something's wrong. Just a second. Just a second.
It's the same effect.
Oh, okay, sorry. I threw myself off, because I wasn't thinking. All right, sorry, my bad. Let me back up for a second. The 250 that we had here is the unrealized gain and loss on investment. The 250, that's the number that we have right here. Since this is a balance sheet account, it's a real account, it doesn't go away. So they accumulate. Sorry, I should have thought through this before I started teaching it. So we take the 250 and then we subtract the effect of the 10 to get the 240. We take the 240, we add the 110 to get the 350. So since this is a balance sheet account, it accumulates, while in the other one, it just went through the income statement and then flowed the retained earnings, and retained earnings accumulated. Does that make sense, at least sort of? Took me a second to remember how we did this. And then finally, for the statement of cash flows for this problem, in the operating section, the dividends would still show up in the operating section, but the purchase and the sale, when we're talking about available for sale, usually goes in the investing section. So the only difference here is that these two items would go in the investing section and the cash dividends would go in the operating section. Any dividends received always goes in the operating section in the statement of cash flows. That is 335, yes. Any questions? This is fun, right? Not fun? Not at all. It was a little fun, no? Oh, with a headache, when it's the worst. All right, so that is available for sale. Again, the key point, or the key thing to learn here is what happens to the unrealized gains and losses. For trading, they go on the income statement and then flow through retained earnings. For available for sale, they skip the income statement and go directly to accumulated other comprehensive income, which is on the balance sheet in the shareholders' equity section. It's the key thing to learn between the two problems that we're looking at here. So you will do a very similar problem to this on the second exam, and so practicing this will be helpful. And I won't tell you if it's either going to be 2 or 3, one or the other. Actually, I changed my mind. The problem I usually use is a combination of the two, so you have some of each you have to deal with, which makes it a little bit more fun.
Thanks.
All right, so I have 1 hour remaining. I think what we'll do to yeah. To break it up, we're going to do one thing in between here, and then we'll jump back into the notes. So what I'm passing out now is an excerpt from 2010 Berkshire Hathaway shareholder letter. This is our good friend Warren Buffett, or many of you know who that is. Probably the most famous investor in the United States, or probably in the world. So Warren Buffett is the chairman of the board of a company known as Berkshire Hathaway. Berkshire Hathaway is really an investment company. They invest in lots of other companies. They own companies like Geico and NetJets and a furniture company and some jewelry companies and a whole bunch of other stuff. I mean, and they own a whole bunch of Coca-Cola and a bunch of other stuff as well. But Warren Buffett, this very eccentric older gentleman, he, in each shareholder letter, after they talk about the various segments of Berkshire Hathaway, he kind of talks about whatever he wants to. There's always a couple sections of him just spouting off on whatever he wants to talk about. And he likes accounting a lot, so he actually talks about accounting pretty regularly. And in this particular shareholder letter, one of the topics that he talks about is specific to financial accounting and the accounting rules that we've been talking about today. And it's kind of an interesting perspective. And so here we have Berkshire Hathaway shareholder letter 2010, Warren Buffett. So he starts by talking about all of the segments of Berkshire Hathaway. And one thing he never talks about in there is the net income associated with any of them, or with Berkshire Hathaway as a whole. And so this is the section title that he gave this section. It's on reporting and misreporting, the numbers that count and those that don't. And so he says, earlier in this letter I pointed out some numbers that Charlie and I find useful in valuing Berkshire and measuring its progress. Let's focus here on a number we omitted, but which many in the media feature above all others, net income. Important though that number may be at most companies, it is almost always meaningless at Berkshire. Regardless of how our business might be doing, Charlie and I could, quite legally, cause net income in any given period to be almost any number we would like. Okay, so he just said that he could make Berkshire Hathaway's net income number any number he chooses within the rules of GAAP. He can just pick a number and he can make it that number. Okay, now we're going to find out how he says he can do that. We have that flexibility because realized gains or losses on investments go into net income, whereas unrealized gains, in most cases losses, are excluded. What type of investment is he talking about? Only one of the 5 categories we talked about, this is the case. Which one is he talking about? He's talking about available for sale securities, ones we just dealt with. Realized gains and losses go on the income statement. Unrealized gains and losses go not on the income statement. They go on the balance sheet. Okay? So he says, for example, imagine that Berkshire had a $10 billion increase in unrealized gains in a given period and concurrently had $1 billion of realized losses. Our net income, which would only account the loss, would be reported as less than our operating income. If we had meanwhile realized gains in the previous year, headlines might proclaim that our earnings were down X% when in reality our business might be much improved. If we really thought net income important, we could regularly feed realized gains into it simply because we have a huge amount of unrealized gains upon which to draw. So what does he say he has to do to make net income go up? What does he do? Sell specifically what?
Available for sale.
Available for sale securities that have unrealized gains associated with them. So all he has to do is he has to go and pick one investment that he has in something that has gone up in value, and as soon as he sells that, net income increases by that amount immediately. Or it doesn't if he doesn't sell it. So he can move net income up by just selling investments that he has with unrealized gains and losses when they're classified as available for sale. What does he have to do if he wants to make net income go down? Find investments that have unrealized losses and sell those. He just picks the amount he wants it to go up or down, figure out how many of a particular security he needs to sell, either sell the ones with unrealized gains or unrealized losses, boom, he can move net income up or down as much as he wants. Quite legally, within the rules, you can sell your investments anytime you want. And the rules say, if you sell them, they go into net income. If you don't sell them, they don't. Okay? And then you could just go and buy the investments again 2 days later and be no skin off his nose. Right? You'd still hold the exact same things he had previously. Is that concerning to any of you? It should be very concerning, right? He's basically saying net income is garbage because I can make any number I want. Okay? So, are we concerned about this with other companies? Not as much. Why not?
Because they don't trade at the level they want.
Okay, so they certainly don't have as many unrealized gains and unrealized losses as this company does. But every company is going to have some. So they could manipulate their earnings some if they chose to with this particular method. You're exactly right. So most companies could not make their net income any number they wanted, but they could make it go up or down some if they chose to, just by selling some investments that they previously had purchased. This is a deficiency in financial accounting that everyone should be aware of, because we all know it's broken, but we don't have a solution to it. The FASB actually, I guess it's been 2 years now, had a proposed new standard for dealing with available for sale securities. Basically, they were going to get rid of them. They were going to treat everything the same way that we treat trading securities, which is we're going to record all of the increases and decreases on the income statement. Well, corporations freaked out. They did not like this idea, and specifically, financial institutions didn't like this idea. Any idea why? What would putting those things on your income statement do? First, it would give the investors a whole lot more information.
Yeah,
You might argue that's bad.
It'll make a net income dependent on the market more.
Very good. It's going to create a whole bunch of variation in your earnings, right? So, just as an example, in this thing we just did, you see here, we had our net income of 260, then negative 10, then 95. That's the trading. Available for sale, much smaller effects on our net income. And that's exactly what would happen. Is if you moved all those things, so everything got marked to fair value and those changes went through your net income, there'd be a whole bunch more variation in net income. Managers don't like that, and so they basically yelled until the FASB said, okay, fine, we won't do it. And so the FASB backed down and did not go forward with that particular standard. Though everyone knows the way that we're currently doing it is broken. But we don't, firms are not willing to do something and will not allow the FASB to do something to fix it. All right, so we'll go ahead and finish this real quick. He basically, I'll just summarize. He basically says, we don't do this. We're not jerks. And then he has a solution. Operating earnings, despite having some shortcomings, are in general a reasonable guide to how our business is doing. Ignore our net income figure, however. So why does he say look at operating earnings? Think about the income statement.
Well, that's,
It's before tax, and more importantly, it's before gains and losses. It excludes gains and losses, realized or otherwise, from investments. It excludes all of the investment earnings and gains and losses, both unrealized and realized. So you can't affect operating earnings from doing this. So if you look at operating earnings, you're going to be okay, is what he's saying. Ignore net income, however. Regulations require that we report it to you, but if you find reporters focusing on it, that will speak more to their performance than ours. Which is kind of funny. Both realized and unrealized gains and losses are fully reflected in the calculation of our book value. Pay attention to the changes in that metric and to the course of our operating earnings, and you'll be on the right track. So, kind of an interesting real-world perspective of the accounting we were just dealing with. Some issues with those available for sale securities. So do we have the same issue with trading securities? No, because selling them doesn't do anything. The effect that you're going to have on your income statement is the same either way. You sell it or you keep it, it's all going to affect net income the same way.